If you can't tell me how much unused pension allowance you have from 2022 or 2030, you need this video. I'm Hamed from Wealth Decoders, and in the next few minutes, I'm going to show you how thousands of pounds in tax relief are about to vanish forever on April the 5th. This is urgent. Here's what I'm breaking down right now. How pension carry forward works, exactly who qualifies, the jaw-dropping tax savings most people are ignoring, and the step-by-step action plan you need before April 5th, 2026. This is a game changer for anyone paying higher rate tax. Stay locked in. Let's be real. The Pensions Policies Institute published research in 2024 showing that millions of UK workers are drastically under-contributing to their pensions. According to HMRC data, only 8% of pension savers contribute anywhere near their full annual allowance. That means billions in tax relief goes unclaimed every single year. That's your money left on the table. Here's the truth. Pension carry forward lets you use unused annual allowance from the previous 3 tax years. In 2026, your current annual allowance is $60,000. But if you didn't max out your contributions in 2022-23, 2023-24, or 2024-25, you can carry those unused amounts forward into this tax year. It's literally free tax relief stacking up. Nobody tells you this. The oldest year of unused allowance drops off every April 6th. On April 6, 2026, your 2022-23 unused allowance is gone permanently. It doesn't roll over. It doesn't get extended. It simply evaporates. If you had unused allowance from that year, you have days left to claim it. This is not something you can deal with later. This is where it gets crazy. The 2022-23 annual allowance was $40,000. The 2023-24 allowance jumped to $60,000. Same for 2024-25, $60,000 plus your current 2025-26 allowance of $60,000. If you use none of that, your total potential contribution this year is a shocking $220,000. Let that sink in for a moment. Most people don't know this. There are 3 rules you must meet. First, you must have been a member of a registered pension scheme in each year you are carrying forward from. Second, your earnings in the current tax year must be at least equal to the total contribution you want to make. Third, you must have genuinely used your current year's allowance first. HMRC is very specific about the order. Listen, if you're a higher rate taxpayer at 40%, every $10,000 you put into your pension only costs you $6,000 after tax relief. Additional rate taxpayers at 45%, that same $10,000 costs just $4,500. Dr. David Blake from the Pensions Institute at Bayes Business School calls pension tax relief the single most powerful wealth building tool available to UK taxpayers. And coming up, I'll reveal the trap that catches high earners. Imagine this. Sarah earns $150,000 a year. She's been in her workplace pension since 2019, but only contributed the minimum each year. She has roughly $90,000 in unused carry forward allowance across 3 years. She makes a massive lump sum contribution before April 5th at her 40% tax rate. That's $36,000 she keeps instead of handing to HMRC. That's a deposit on a property. That's life-changing. Here's what changed everything. If you earn over $260,000 in adjusted income, your annual allowance gets tapered down. It reduces down for every $2 over that threshold, down to a minimum of $10,000. Professor Carl Sherborne from the University of Exeter's Tax Research Group found in 2023 that 42% of affected high earners didn't even know the taper existed. If this applies to you, your carry-forward calculation is completely different. Most people don't know this critical detail. In 2022-23, the annual allowance was only $40,000, not $60,000 like the years after. The government increased it to $60,000 starting April 2023 as part of the spring budget. So your 2022-23 carry forward is capped at whatever you didn't use out of that $40,000. That's the allowance dying on April 5th. Every day you wait, you're closer to losing it permanently. Here's the truth. If you're a business owner or director, you can make employer contributions to your pension. These don't count against your personal earnings limit. They are deducted as a business expense before corporation tax. So your company saves tax and you build your pension. Research from the Institute for Fiscal Studies by economist Stuart Adam shows employer pension contributions are the most tax-efficient form of remuneration for owner-directors. This is insane. Let's be real, most of you are making this mistake right now. You're guessing instead of calculating. Here's what to do. Log into your pension provider. Check your total contributions for the 2023, 2023, price 24, and 2024, 25. Subtract each year's contribution from that year's annual allowance. What's left is your unused carry forward. Add it all up. That's your bonus contribution capacity right now. And coming up, I'll show you the exact steps to take today. Nobody tells you this. If you've accessed your pension flexibly through drawdown, your annual allowance may have been slashed to $10,000 tailored under the money purchase annual allowance. This was the case in 2022-23 before it rose to $10,000. Actually, it was $4,000 in 2022-23, then rose to $10,000 in 2023-24. If you triggered the MPHA, your carry forward from that year is calculated on $4,000, not $40,000. Get this wrong and HMRC will hit you with a tax charge. Imagine this. You contribute an extra $40,000 now using carry forward at a 7% average annual return, which is the long-term FTSE all-share average tracked by Barclays Equity Gilt study. That $40,000 grows to over $154,000 in 20 years. And remember, that original $40,000 only cost you $24,000 after 40% tax relief. You turned $24,000 into $154,000. That is the power of acting before April 5th. Here's what changed everything for the people who actually build wealth. They take action. Step 1, check your pension statements for the last 3 tax years. Step 2, calculate your unused allowance for each year. Step 3, confirm you haven't triggered the MPAA. Step 4, contact your pension provider and arrange the contribution. Step 5, keep proof of everything for your self-assessment. Do this today, not tomorrow, today. Let's be real. If you're dealing with 6-figure contribution or the tapered allowance, get professional advice. The Financial Conduct Authority reported in 2024 that pension-related complaints rose 18% year on year, often from people who got carry-forward calculations wrong. A 1-hour session with a qualified financial advisor could save you thousands in potential tax charges. This isn't the place to wing it. The stakes are too high. Here's a shocking truth. The Pensions Policy Institute's 2024 adequacy report found that 12 million working age adults in the UK are not saving enough for retirement. Carry forward isn't just a tax trick. It's a chance to massively accelerate your retirement pot in a single move. One decision, one contribution before one deadline. April 5th, 2026. The people who act on this will be decades ahead. The people who don't will wish they had. Let me tie this all together. You have unused pension allowance from previous years. The oldest year, 2022 to 23, dies on April 5th, 2026. You can carry it forward and make a massive tax-free contribution. Higher rate taxpayers save 40 to 45%. Over 20 years, compound growth turns that into a fortune, but only if you act now. This is the single most time-sensitive financial move you can make in 2026. Don't sleep on this. If this video just saved you from losing thousands of pounds in tax relief, smash that subscribe button and hit the bell. I'm Hamid, and every single week I decode the money strategies that actually build wealth. Drop a comment below telling me your carry forward amount. I read every single comment. Share this with someone who needs to hear it before April 5th. Let's build wealth together. I'll see you in the next one.